talked a little bit about some barriers with the legal and the political systems. Are there any cultural values or priorities that you need to take into account as well?
Yeah, I think absolutely. Culturally, I think the economics and the culture in any country are so intimately connected. It's hard to separate it. But you know, in the world of financing, you often get these sort of financing gaps where, you know, early stage companies can receive money in the beginning, for example, through maybe microfinancing now, but oftentimes through friends and family and networks, and then institutional money can come in later. Well, how do you fund that gap in between? And I think that has a lot to do with culture. In Latin American countries, there are a lot of large family businesses. There are family groups. There are sort of family conglomerates. There are families that have accumulated wealth, and a lot of the funding of these early ventures sort of needs to come from that, because you have this gap where you don't have traditional venture capital. You don't have a lot of wealthy angel investors walking around like you do in Silicon Valley. So what do you rely on? And I think culturally, you have a lot of family business. That's a big part of the culture, and I think that will remain important even when venture capital institutions come into play. So the networks and so forth, I think culturally, you know, not only across countries, but even within the United States, you can see the difference in culture. The culture in Silicon Valley is extremely unique. The focus there on high technology startups, the institutions that you have there, the universities, the research labs, I mean, it's like there's a whole culture around innovation and technology and startups and venture capital and stock options. I mean, if you're walking around the streets or eating in a restaurant, you hear people talking about this stuff. You know, it's like it's so embedded in the culture of Silicon Valley. So that's even very different from most American cities. So you can imagine the cultural difference in emerging and developing countries where you just don't have oftentimes the education levels across the whole economy, the kinds of institutions that are generating breakthrough discoveries, the science base, the technology base. A lot of these things are what feed into the culture of entrepreneurs. So you might find, again, more family businesses, more retail chains, more restaurants, more things like that, whereas the general culture is not to think all the time about breakthrough high technology ventures. I think it's changing a lot from technology. You know, now you have worldwide, you have people on Facebook, you have people using technology, you have people with Apple computers everywhere now. So I think that the technology will help, you know, introduce opportunities to people who didn't have that in the past. And again, I think it's very difficult to untangle the economics and the culture. A lot of it's driven by a lack of wealth, often means a lack of certain kinds of opportunities and things that you need that become inputs into new startup companies. But you know, immigrant entrepreneurship in the U.S. has been incredible, and you find a lot of people coming from countries where they really don't have much at all, and they become very successful, wealthy entrepreneurs in the United States. So the potential is there, but you need a lot of the causes and conditions to unleash that potential. And I think, you know, venture capital is one of those things, but there are a lot of others too. Great.
Well, now I was just thinking about how you talked about the legal and the political system, some cultural values. You're looking at risk as a venture capitalist. Are there other things beyond risk that maybe a U.S. investor who wants to get into venture capitalism in another country or another region of the world, some things that they might have to think about? Yeah,
I mean, for sure. I mean, one thing I didn't mention in the conversation about culture, which is maybe so obvious that I didn't think of it though, but language. You know, language is a huge difference. And when we did our research, we wanted to look at emerging markets. And we thought, well, Latin America is a nice sample because most of the countries, at least they're speaking the same language, or they can can understand each language. Even Brazil, they're speaking Portuguese in Brazil and Spanish in Argentina right next door, but they can communicate. So it may not be totally fair to compare Latin America with Eastern Europe, for example, because there are other cultural differences, there are other language barriers. So we looked at Latin America as a whole to try to minimize the cultural differences across countries. So it was a nice setting to do that in. But language alone. I mean, if I'm a venture capitalist in the United States and I don't speak Spanish, how comfortable is it to go to a board meeting at a company in Chile and really understand what they're talking about and feel confident that I can help and network for them and try to help them find a new CFO, for example, or a supplier and so forth. So language alone, you start with that, is difficult. And I think part of why we're seeing a venture capital community develop in Brazil is because many of the venture capitalists in Brazil have even been educated in the US. So maybe they've come to a business school in the US, maybe they've been with a large company in the US, maybe Hewlett Packard or Microsoft or something like that, and then they want to go back to their home country and they bring the knowledge back, but then they also understand the culture and they understand the language and they understand the network. Who you need to know is often as important as what you need to know. And so I think across the world, different countries operate differently. I have some other research on developing economies that I've looked at, many countries, not just Latin America, where we looked at bureaucracy and how entrepreneurs deal with bureaucracy. So for example, in China, it's a very different situation to be in China dealing with bureaucracy and trying to figure out, how to become a successful entrepreneur as it would be in the United States versus, say, Italy. I mean, so there are a lot of barriers like that. And that's why I think, it's not, part of the analysis we've done is money flowing into these countries from outside. But then part of what we're looking at more now is the money within the countries and within the continent flowing across country boundaries. So I think the question you're asking about the barriers, one big barrier is for capital to come in from the outside. Other barriers are capital, even within the country already or in neighboring countries, and what kind of barriers are there. So there's different levels of thinking about this, but certainly language barriers and cultural barriers and educational differences, and there's so many factors involved, and so we kind of started with the venture capital as such an extreme contrast that we could get our arms around it and dig in there and see, like, there must be some really big things happening here because it's so different, and we found a few of those.
So we've been talking a lot about the negatives, about the barriers of investing in certain countries or across cultures or looking at that. What's the benefit?
Yeah. I mean, the benefits are huge, I think, and that's why it makes it worthwhile to look at it. It's always easy to look at the problems, but and you can sort of poke holes in any opportunity and say, well, this is why that won't work and so forth. But the opportunities in developing countries are much greater than the opportunities in developed countries. The economy in the U.S. recently is growing at, 2.5%? I mean, we get excited about 3% growth. In China, recently the growth came down from, say, 12% to 8%, and they thought, oh, that's a big drop. We'd be ecstatic with 8% growth, and we'd probably start worrying about inflation and all the other old problems we had. But so the developed world is actually in a very, very slow growth phase, but the emerging economies are in high growth phase, and potentially most of the growth in the world will come from those areas in the future. So there's great opportunity. You have, think about the cost to start businesses in Silicon Valley. The labor costs, the real estate costs, the taxes. I mean, it's actually really expensive to run a company in Silicon Valley. If you could start a company in Costa Rica and build it, wow, that would be great. So I think the benefits not only to the investors and to the world economy are there, but clearly to the people. The income disparities in some of the countries, particularly in Latin America, but in most developing countries, are quite wide. I mean, there's a huge percentage of the population that's still living on $1 or $2 a day. It's hard to imagine, the bottom of the pyramid kinds of issues that we're dealing with. And it's often said you need money to make money, and I think it's not necessarily true, but when you're talking about building real sustainable companies that have an impact in the world and hire hundreds or thousands of people, like the kinds of companies that are produced almost overnight in the US. Now, you do need that capital. You need that free flow of capital. A company like Uber, for example, or Facebook, or these become very large companies. They employ a lot of people. They create a lot of jobs and wealth for people, but they're not really sprouting up from developing economies yet. And you need a lot of conditions and a lot of pieces of the puzzles to come together for that to happen. It will happen, but it's going to take time. So I think that's why it's worth understanding these things. And yeah.
Well, my final question is just to ask you what's next for you in your research.
Sure.
And maybe particularly in Latin America or in venture capital.
Yeah. Well, my colleague on the prior work he's actually moved back to Chile now. So he's at a university in Chile. So we're continuing that work. He has a doctoral student that has now come to the U.S. to finish his PhD, and so he's joined the team. So there's a lot of interest. We're actually admitting a doctoral student this year in the management department who seems to have an interest also in Latin America. He lived there for a while, speaks Spanish, and so forth. So I think it's very promising for this stream of research to continue, and we're already working on kind of the next phase and the next article that we plan to publish, which we'll actually be presenting on at a conference in Vancouver in August. And what we're looking at now is we're widening the study beyond simply venture capital to the wider area of what you call private equity. So not public markets of IPOs and publicly traded stocks, but sort of all private equity, which includes as part of that venture capital, but also other kinds of investors who invest private money through funds or individually. So we're expanding the scope of the study, and we want to try to understand even more about how the institutions play a role, more so within Latin America. Not so much attracting money from outside of Latin America, but even within Latin America. And the key finding so far is, which we felt was true, and we wanted to understand it better, is that everything we're talking about here is a relative concept. So if you're a developing country, it may not matter so much how well developed you are, but what it matters is how well you are developed amongst your neighbors and your peers. So even for a lesser developed country, they might be able to draw capital from other countries in their region because those other countries also need diversification in their portfolios. So if I'm an investor in Argentina, and my economy is already very well developed, for example, compared to Peru might actually present emerging market opportunities, so that I might want to seek even higher growth within my industry in a lesser developed economy. However, if the institutions are even worse than my own, then that presents a greater risk to me. Likewise, if I'm in, say, Peru, and I'm not very comfortable with the institutions in my country, I might invest in Brazil or Argentina. So I think it's not so simple as money flowing into the continent. There's still a lot of disparity across the different countries within the continent. And so we're getting a better handle now on that. And the next real finding is that this is a relative concept. And what you have to do is you have to achieve a level of development to get your country above a certain bar relative to your peers. And once you do that, capital can start to flow in, even from places that you might not expect. So you still may not be able to attract a lot of capital from the United States, but you might attract capital from a neighboring country for various reasons. So
talking about that bar, is there a certain range of capital that somebody needs to, so if you give too little, they're not successful because they can't do anything with it, but if you give too much, they actually don't have the capacity and they're kind of they're overcommitted for what they can do.
Yeah, actually this is really one of the key findings from the first work, which is that in the United States venture capitalists stage their money in. So if you're going to put, say, $10 million into a particular company, that's going to come in over time. So they might get $2 million first, and once they hit a certain milestone, then they might get another $5 million, and then as they hit other milestones, then they are able to achieve, receive more capital from other sources and so forth. So, but at any point in time, if the company is not developing its products or services or market in the way it was hoped, then that capital can dry up. So what we found in Latin America is that those earlier stages are just being skipped by venture capitalists. So they will sit back and wait longer, and maybe even put in higher amounts. As I talked about before, they might even wait longer and then put in higher amounts later, and that's how they'll manage the risk. So you do get this big gap opening up, and I think microfinancing has helped at the very, very low end. Venture capitalists are waiting longer on the higher end, so there's this gap that's opened up in the middle, which is not really a problem in the United States. We have different institutions that fill in those gaps, whether it's crowdfunding or angel investing or smaller VCs. But that gap might persist longer in a lesser developed country. So, whereas, it's kind of the idea of, well, if I put in $1 million, that's not going to be enough. I mean, it's not going to do anything, so I'm going to lose it all. But I don't want to put in $5 million because it's too risky. So I'm just going to wait or not, or not invest there. So that's where these other institutions have to come in. I think, to be honest, crowdfunding is a really high potential vehicle for filling that gap, because even in the U.S., you'll see a crowdfunding campaign for $1,000, but you might see one for $10,000, and now we've seen crowdfunding campaigns for over $1 million. So I think the nice thing about the United States, because of our legal and political systems and other institutions, new financing vehicles can emerge. We're entrepreneurial, and we'll find ways of solving these problems because we're free to do so and have a lot of great resources and freedoms here to do that. So other countries can kind of emulate that environment by thinking about how to unleash that potential and unleash those sort of freedoms with the institutional framework to help those things develop on their own. And I think we're starting to see it, worldwide, but these things take time.
Okay. Well, thank you very much. I appreciate your time, and I think this is some fabulous information, and look forward to reading your next research.
Thanks. It was great. Thanks for having me.
Have a good day.